3 identical envelopes, each holding $1,000. On the 20th of January, 2025, as Donald Trump took the oath of office, you allocate them. One goes into gold, the classic hedge. One goes into Bitcoin, the digital gold that was supposed to rocket on a wave of pro-crypto policy. And the third goes into a brand new asset, the official Trump meme coin, launched just days before the inauguration. Fast forward to today, Wednesday the 5th of August, 2026. Those envelopes are opened. Gold has delivered a respectable $1,224. Bitcoin has shrunk to just $607. And the Trump coin? A staggering $32. That is not a typo. $1,000 turned into 32. A loss of nearly 97%. Those numbers alone are shocking, but they only scratch the surface. Behind each figure lies a chain of cause and effect that rewrites everything we thought we knew about the so-called Trump trade. Over the next few minutes, we are going to dissect why gold quietly thrived, why Bitcoin disappointed, and how a presidential token became one of the fastest wealth destructions in modern financial memory. Gold tends to be perceived as dull, a relic for nervous grandparents. Yet a 22.4% gain in roughly 18 months is anything but boring. To understand this, we have to look at what the world did not expect at the start of 2025. The prevailing narrative was that Trump's tax cuts and deregulation would ignite a US stock market boom and that crypto would soar. Gold was supposedly obsolete. Reality played out differently. Central banks, particularly in China and India, embarked on a relentless buying spree that continues through the summer of 2026. They wanted an asset free from American political risk. Simultaneously, lingering inflation proved stickier than the Federal Reserve predicted. Real yields on bonds fell, which is a green light for gold because you are not punished for holding a zero-yield asset. On top of that, geopolitical friction from Eastern Europe to the South China Sea kept a steady bid under physical bullion. So that $1,000 allocation bought a fraction of an ounce in January 2025, and today that same fraction fetches $1,224. It was not luck, it was the result of deep, structural demand from institutions that see gold as the ultimate insurance policy in an era of political trade wars and sovereign distrust. This is the puzzle everyone is still arguing about in pubs and trading forums. On Inauguration Day, Bitcoin stood near $101,000, having hit a record $109,000 just before. The air was electric. Trump had promised to make America the crypto capital of the planet, to establish a strategic Bitcoin reserve, and to sack the regulators the industry hated. If you had asked anyone that day, they would have said Bitcoin to the moon. So why did a $1,000 investment turn into $607? The answer lies in the messy gap between political tweets and legislative reality. The promised regulatory overhaul has been painfully slow, bogged down in Congress. Meanwhile, the Federal Reserve kept interest rates higher for longer than markets had priced in back in early 2025, which hammered all speculative assets. Risk appetite soured. Add to that a high-profile exchange collapse in the first quarter of 2026, not FTX scale but enough to shake confidence, and you have a classic risk-off unwind. Bitcoin proved once again that it trades less like digital gold and more like a leveraged bet on tech liquidity. Despite the presidential cheerleading, macro forces won. The $607 balance today is a sobering reminder that narrative is not the same as price action. Now we come to the most painful envelope, the dollar Trump meme coin. Launched on the 17th of January, 2025, it exploded within hours to a fully diluted valuation of $24.3 billion. FOMO was uncontrollable. A $1,000 investment at Inauguration Day prices bought approximately 22 coins, at roughly $45 each. Today, a single coin trades at $1.47. That $1,000 is worth $32. To lose that much in a major, heavily promoted token is a textbook case of speculative mania meeting reality. The token had no revenue, no utility, and its only value proposition was that it carried the president's brand. Senator Elizabeth Warren has since demanded an official investigation, citing concerns over conflicts of interest and the potential for foreign entities to curry favor by pumping the coin. While that drama unfolds, the chart tells its own story: a sharp spike, a slow bleed, and then a capitulation as insiders and early buyers cashed out, leaving retail holders with worthless digital receipts. Some defenders still call it a collectible, but a collectible that falls 97% while the namesake occupies the White House is a financial warning that will be taught in university courses for years. The call for an investigation is not just political theater. It marks a turning point for the entire category of celebrity and politician-linked tokens. When Senator Warren formally called for a probe 9 hours ago, on the 4th of August, 2026, she cited the $4.8 billion peak market cap and the 97% collapse as evidence of a classic pump and dump that may have violated securities laws. Regardless of the legal outcome, the reputational damage is done. Exchanges are beginning to delist or restrict meme coins with zero utility, and the UK's Financial Conduct Authority has reinforced its stance that such tokens are high-risk, unregulated instruments. For the average viewer, the wider implication is critical: the era of easy money in meme coins is closing. Regulatory risk has become as lethal as market risk. That $32 left from a $1,000 investment is not just a loss, it is a signal that the market is finally drawing a line between speculative gambling and credible digital assets. If you hold similar tokens, this is a wake-up call to assess whether they can survive a regulatory storm that is only gathering strength. Here is a detail that most headlines miss. While gold, Bitcoin, and the Trump coin grabbed the spotlight, a different strategy quietly outperformed them all: a simple, diversified basket of high-quality government bonds and global equities. Data from the same period shows that a classic 60-40 portfolio, with dividends reinvested, would have turned that $1,000 into roughly $1,090. Nothing spectacular, but a steady positive return with a fraction of the volatility. This matters because it exposes the survivorship bias in how we talk about investing. The media loves extreme winners and losers, but the wealthy quietly build fortunes on boring consistency. The smart money that steered clear of the Trump coin and did not go all in on Bitcoin at the top is not on the front page, but it is sleeping well at night. The lesson is not to abandon crypto or gold. It is to understand position sizing. If you put 5% of your portfolio into high-risk assets and 95% into a balanced foundation, a 97% loss on that 5% stings but does not ruin you. Oversized bets on narratives are the common thread behind every disaster in this story. So, on this Wednesday, the 5th of August, 2026, what does this all mean for your next move? For Bitcoin, technical analysts are watching the $58,000 support level nervously. If it holds, a relief rally could materialize if the Fed signals rate cuts later this autumn. However, if recession fears intensify, Bitcoin could easily retest the lows. For gold, the outlook remains constructive. With central banks still accumulating and no resolution to global trade tensions, the floor for bullion seems firm. A retest of $1,300 on that $1,000 original investment is entirely plausible before the year ends. The Trump coin, realistically, faces an existential crisis. With the investigation looming and volume drying up, a recovery to even $5 appears unlikely. More broadly, we are entering an era where investors will demand demonstrable cash flows, real-world use cases, or regulatory clarity before parting with their money. The era of blind narrative chasing is, at least for now, over. The key is to reevaluate your portfolio today, not tomorrow. Check your exposure to meme tokens and ask yourself if you own them for a genuine thesis or just out of hope. Let us bring this home. That original $1,000 is roughly £800 for viewers here in Britain. If you had split that £800 equally 3 ways on Inauguration Day, today you would have about £978 in gold, £485 in Bitcoin, and just under £26 in Trump tokens. The combined pot would be around £1,489, representing a gain from the gold portion that was nearly wiped out by the meme coin disaster. The true takeaway is not that one asset is inherently evil or virtuous. It is that alignment of hype does not equal alignment of returns. Gold rose because the world needed a neutral, physical asset. Bitcoin fell because it was not yet mature enough to withstand macro headwinds, regardless of who sits in the Oval Office. The Trump coin imploded because it was built on nothing but a famous surname. As you navigate the rest of 2026, carry these three numbers with you: 1224, 607, and 32. They are a permanent reminder that in investing, price is what you pay, but value, real underlying value, is what you eventually get. Thank you for watching, and please do subscribe for more independent, data-driven analysis that cuts through the noise.